Thank you for coming. Welcome to the 2020 Annual National REIC Expo. This is our second annual, brought to you by the National Real Estate Investment Club and the Palm Beach Real Estate Investors Association. I'd like to start off by thanking my team, which is my son Robert Green, Austin Green, and John Zorzina, the third. For those of you who don't know me, I'm Jeff Green. I've been in real estate, flipping, wholesaling, and moving for the last 20 years. I've bought and sold over 400 houses. We own Palm Beach Investors Realty, Sunshine State Title, Sunshine State Coverage, a John Bell agency. We work with Real Flow. That's where we get our leads and RE lead system. So, enough of me. It's all about the talent that we brought you here today. Bill Tyler has been my personal CPA and saved me a lot of money. And it is an honor to actually have him here today after having him as my personal CPA for all these years. He's written a few books. He's also a native Floridian. He was born in Miami Beach, and he attended college at the University of Nebraska. He received a full ride scholarship to play football in 1987. Actually tried out for the Dolphins. And he speaks nationally, sharing his 30-plus years of accounting and tax preparation knowledge. And today he has some great information for you. His two books he published was in 2005 and 2009, in the crash. And we survived it. We're all back. And please put your hands together for Bill Tyler.
Great. How are y'all doing? Good. All right. 10 o'clock. Opening shot. I usually go on like around 2 or 3 because you have all the people that tell you how to make money, and then I'm the guy who shows you how to keep all the money. So, but we had some guy, he had some issues in St. Louis weather, so I took the 10 o'clock spot and get out, and it'll be a great thing. So, a lot of fun, a lot of people, a lot of new faces. Real estate. I mean, it's a great thing with real estate. Real estate, you can do so many things. It's all about what you want to do and how you want to do it. There's wholesalers out there. I don't want to rehab. I don't want to be a renter. I don't want to do this. But real estate allows you to just go, I saw a guy, he had deal finder on his shirt. He's just finding the deals and he's selling them to you guys. You do the rehabs, you do this, you do the rentals. I think it's fantastic. It's great. So real estate, there's a lot to do, a lot to have fun, but you've got to be structured correctly. And let me ask you, just by a show of hands, how many people in the room have an LLC? Okay, do you know most of you shouldn't have an LLC? Wow. And I always ask that to people and I say, why did you get an LLC? Well, my friend has one. He told me, and I know another guy, he has like 8 or 10 or 12. Yeah, I know people who have over 20. You don't need all these things because LLCs, they're weird. And I'm going to go through that in my presentation. They're really weird because they can be taxed 5 different ways. An LLC can actually be a C corporation, which is a closed company. It can be an S corporation, which is a pass-through. It can be a multi-member partnership. It can be a single member or a disregarded entity. What's a disregarded entity? Nothing. Exactly what it says. So unless you're doing it with partners, I only recommend the LLCs to have your company be the owners of the LLCs, not you individually, unless you're only doing rental property. So if you're only taking in rentals and this is all this does, you're okay, you're safe. But if you're flipping, don't do it. Not good. So we want to make sure that you all know what's going on. I'm going to stand in front of this probably the whole time, so I'm going to come over here. Good. How to make $100,000 and not pay any taxes in a legal way. 100 grand. Okay. That's pretty cool. So let's see what we got cooking over here. There's the thing. That's what I want to talk about. Major differences between LLCs, S Corps, and C Corps. Like I told you, the LLCs, they can be taxed so many different ways. So you want to keep things simple. All right, that's the big motivation here, is to know what your job is and to do your job. All right, the single member, disregarded, we went through, they're going to file a form Schedule C. Okay, Schedule C is bad. That's all we have to remember. Schedule C is bad. When we have profits, we're going to be taxed an additional 15.3%. I don't want to pay extra taxes. I want to pay Less taxes, right? No, that guy over there, he wants to pay a lot of taxes. Okay, I got one guy, that's it. But so you want to make sure, multi-member partnerships, 1065 is good, but I don't want you to be the individual owner. I want your company to be the individual owner, not you. Take yourself out of the equation. Asset protection takes it away from you. Limit your liability that way. S Corp, C Corp. All companies provide asset protection by separating the entities above from your personal assets. So in cases of creditor, debt, to said, which company? I copied that. The company which includes the Internal Revenue Service. So what they're doing is why we separate the companies from yourself is because of that asset protection. If somebody gets sued, they're only going to come after the company, not after you personally. That's what we want to do. We do not want you to be attacked personally for anything. I had a really crazy story, and it really happened. Had a client who had a tenant, and they fell in their house, and the tenant sued them. They fell in their own home that they were renting, they sued them, and they won. They wanted $200,000, and then I guess they had a really good attorney, because the attorney said, no, let's go after $1 million. And they did. But they could only get what the contribution to the LLC was, or to the S corporation was. So it's important that you take these out of your personal names. If you don't have mortgages on any of these houses, change the titles to your corporations. Okay, change them over. Take things out away from you and put them onto your entity. It's a much easier way to do things. All right, some self-employment taxes. I talked a little bit about that earlier. Multi-member company or partnerships, they are going to pay self-employment taxes. Single-member LLC, disregarded entity, they're going to pay self-employment taxes. 15.3%. So if I just have a $10,000 profit, which isn't a lot, okay? After all my deductions, my ordinary income is zero. I have nothing. You're still going to pay $1,530 in self-employment tax if you have it in any of these entities. Rental income profits, capital gains, interest income, dividend income are exempt. You don't have that, but we want to make sure we're structured right? We're getting into this, we're putting ourselves on the line. We want to make sure that we're protected. So get those companies that you need. Do you need 20? No, you really don't. And I'm going to get into that as well. There's not a lot of people that need 20 companies. Structure is everything. As I said before, the S corporations are pass-through entities. They're going to pass through your personal tax returns that are there. S corporations can only be owned by you personally. So, if you're an S corporation, only individuals can own that. You can only have that as yourself. I'm going to show you a way to still protect your assets as well in this presentation. S corporations enjoy a few more benefits than LLCs. And I'm going to get into that as well because so many other people want to talk about what I can deduct and what I can't deduct. And I see that all the time. You'd be amazed at what people call and ask me. I need to get a guitar for my friend here. Can I deduct that? Are you a musician? No. We can't deduct that. You got to use a lot of common sense here, guys. That's what it really boils down to be. Closing the corporation. I referred earlier to C corporations. C corporations are great. Okay, a lot of people go into double taxation. They go into all these different things, how bad C corporations are. But right now, they're all flat taxed at 21%. So that law changed in 2018. And in 2018, did anybody take advantage of all the crazy deductions out there for 2018 I spoke about last year? Did anybody buy a new car? Nobody bought a new car. Okay, you got a car, so great. You bought a car out there. Did you know one of the new laws is that when you purchase the vehicle and you're using that vehicle for business, you can accelerate the depreciation of $18,000 last year immediately on that vehicle. If it's over 6,000 pounds, if you bought an Escalade or a Yukon, it's 100% deductible. Wow, nobody took advantage of that. I had my clients come in December. I was crazy busy last December. They were leasing at the time because that's what the accountants say to do is to lease so we can write that payment off. I had them all buy them in December. So they got the deduction. The really cool thing is, one, bought an Audi Q56, I think, or 80. It was a big truck, over 8,000 pounds. In December, it was $104,000 that he spent on the car. He put down $10,000 in cash, financed the rest of it, but took a $104,000 deduction. Wow. Yeah, you can do that. Okay, does the company have to buy the car? No. You can act as the credit angel for the company. If your company's new, you're not going to have any credit. You're going to have to wait 2 years to get credit through your corporation. So you can act as the credit angel for your company in order to purchase that vehicle. The down payment comes out of the corporation, and the monthly payment comes out of the corporation. Just like leasing. Great deduction that they had last year. Closing the corporation is great again, 21%. For those people who are making 500, a million, 2 million, corporately they were paying up to 38% on that money. Now they're all flat at 21. So that is a better thing. State tax returns. So, we're in Florida, and I assume a lot of you are from Florida. And Florida does not have a state tax, but it does have a corporate tax. It's 5.5%. So they do give you a little something. It used to be 25, and now they upped it a little bit. They're giving you a $50,000 exemption. So if you make a $100,000 profit in the state of Florida, you're going to pay your 21% federally done, but then the state of Florida is going to attack you at 5.5%, another $2,500. So make sure you're structured correctly. This is very important in this stuff. All right, let's see, we got another one here. Real estate related structure. Like I said, guys, keep it simple. Don't need an LLC for each property owner. Do I need separate entities if I'm just managing the property? Yeah. So that's the key here, is that we want to separate what your companies do. Okay, so whether you're renting, flipping, wholesaling, you want to have one company, and I'm going to get into that too, is going to be able to buy, sell, and hold your property. You want another company that's going to manage your company. So that same scenario I told you before with that person who was renting and they sued them, who would they sue if they're making the check out to the property management company every month? Who are they going to sue? Property management. What do they own? Nothing. There's nothing to get. We separate the entities out. All right, and that's a good thing for C corporations as well. Very popular is different states. Buying in different states. Can I have a Florida company and buy in North Carolina? Absolutely. Sure you can. You do got to register in North Carolina as a corporation there, but they have a tax. But what about Nevada? What about Texas? What about Delaware? These are some states that don't have the state taxes either. So we want to look into that as well. How many corporations do I really need? You need 2. That's what you really need is 2. Again, the difference between holding a company, property management. Can I incorporate the state of Nevada, Delaware, Wyoming to save taxes? 150%. Okay? I did research back in 2000 and did a lot of research and back and forth. It took me about 2.5 years to get the system down. That's why I published my first book in 2005 called Living in Corporate America. And it was based on the taxes in the state of Nevada and how Nevada is so business friendly. Completely business friendly, unlike a lot of other states. Delaware and Wyoming have the same model. I like the fact that no matter how much I make, the state doesn't want my money. That's a good thing. I got enough partners with the federal government, right? There's enough going on. So yes, you can have these other companies set up. All right, what do we got? The dynamic duo. So here's what I'm going to show you. This is a structure that I designed back in 2003, and that's what the book is about, this design and structure in 2005. This structure and design still holds true to today. It still works. People are using it all over the country. Because like I said, I do speak all over the country, many different states, many different things. A lot of fun talking and meeting new people and seeing what they're doing and helping people out to show them what they need to be doing, or at least having the knowledge to ask their accountant, hey, so I heard about this. What do you think about that? Because a lot of people say, why doesn't my accountant know this? They may, but you didn't ask. Well, I didn't know to ask. Well, now you do. So you have to arm yourself with that information and give you the knowledge to empower your company and grow your wealth. That's what you want to do. Okay, so example is a hypothetical situation I'm going to give you. All right? So this is about buy to sell using two companies. Both corporations are created in the state of Nevada for the no corporate income tax and no personal income tax in this state. It's very simple numbers. It's a single person who did this who owns both corporations. This individual, for this example, has no other taxable income for the year, and the tax rates are examples as given in 2018 tax law. Tax rate hasn't changed in 2019. So everything is pretty much the same. There wasn't any big changes in 2019. Cryptocurrency. That was a big change. Anybody do cryptocurrency, the Bitcoin and stuff? You guys are in trouble, man. They're going to get crazy out there. I have a guy, he comes in and he does it every year, and he brings me the Schedule D. He's like, here, man, it's like 9 pages. I've got to attach to the tax return. There's all the different trading going on. They're cracking down on more of this, and it's really cracking down more of who's not claiming what, and oh, well, I traded this in a different country. I don't have to do that. Or I did this and I did that. That's the only big thing that I've heard so far. Other than that, your standard deduction has gone up $100. Your exemption for the cars has gone up $100. The car exemption is huge. You guys who are leasing out there, you need to rethink of that $400, $500, $600 lease payment that you're writing off and take that big car. But do that in a year when you make a big profit. You know, I have a guy, he did that too. He says, yeah, I'm waiting on this house, but I want to buy a boat for the company. Well, yeah, you don't have any income to offset it. Yeah, but I really want the boat. Now, I understand that. It's a $150,000 boat that we can take the deduction, but you're not going to get any benefit from it. So wait till you make that big money. Wait till you have that and buy those assets that you can take advantage of. All right, so the dynamic duo is ready to rock and roll. Here we go. Corporation A. We're going to use two companies here, A and B. Real simple. Okay, this corporation is a C corporation. It sits on its own. It doesn't pass through to anyone, doesn't do anything. Its primary purpose is to buy, sell, and hold residential property. There are no capital gains in this situation. Why? The company is designed to just buy, sell, and hold. That means it's ordinary income to the company versus if you personally sold it and you were working at AT&T or wherever, it's a capital gain. This is ordinary income. The purchases said property, it holds said property, it sells said property. That's it. It does not collect rent, it does not manage the property, it doesn't do the rehab costs, it does nothing but buy, sell, and hold. And I know I'm kind of standing all your guys' way over there, and I will go over here for a little bit so you can see that. This is what the company does. Corporation B, this is a property management company. This company does just that. It goes ahead and manages all of the assets that are held by Corporation A. It owns nothing. Okay, it is basically in charge, okay, of rehab, collecting the rent, supervises construction, and it pays for all the direct expenses for the company and indirect expenses for the shareholders. That's where I get to have fun with my indirect expenses, okay? It doesn't own anything, doesn't have anything, it just manages. So the corporation has bought a property. Corporation A has bought this property cash, okay, and put it in its own name. That's where it is. The deal was all done, cash, property is $100,000. It hires Corporation B for its renovations, repairs, and its maintenance, because that is its specific function. Corporation B takes on that management role and spends $50,000 in renovation costs. That's really, you know, for some it's a little high, for some it's a lot low. So I kind of use the numbers to make it simple for everybody to kind of see what we're doing and how we're doing it. Your renovations might have gone over, they might have been under, but it's a fair number. As well, it intends on making a profit for the company, so when it goes and invoices Corporation A, it's going to invoice just a bit more than just $50,000 because we got to make a profit here. All right, we found a buyer. Corporation A sells the property and at a full ask. That doesn't happen. The asking price is $200,000. As you can see, the net profit is $100,000. If I'm a C corporation, I'm going to go ahead and pay $21,000 in taxes. 21% of the profit. But the good thing is you came to today's seminar, and I'm showing you how not to do that. Corporation B wants some of that action, so here's where it gets fun. So Corporation A has paid the $100,000 in cash. It's sitting on their cash money in the bank. Corporation B invoices Corporation A for its renovations, maintenance, utilities, subcontract labor for $100,000. Does Corporation A have it? Yeah, they got it, so they can pay it. Corporation pays the invoice to Corporation B, no longer has a profit, and it pays 0 in federal and state taxes. I've wiped out all the profit in Corporation A. I got to pick it up, though. Okay, I got to pick it up as income, Corporation B. If I don't do that, that's the illegal way to do things. Don't do the illegal way to do things. The legal way is to pick it up, and that's what we did. So we went ahead and picked up income and expenses, so we already know the profit's $100,000. We know that Corporation B had expenses of $50,000, so we can conclude at this point Corporation B has a net profit of $50,000, and it's going to pass through to the individual's tax return. Why the individual? The individual is the one who can only own S corporations. Okay, that's there. What about indirect expenses? Have you guys heard of these before? Indirect. Things that cost me money that are not directly associated with the house. This will work. There you go. Indirect expenses. So the company had to pay the labor. We got that as a direct cost. What about telephone? Can it pay for your cell phone? Of course it can. So the company has that expense going on. Unlike direct expenses like labor and supplies, we do different things. There's your automobile. So your lease payment. You had this for 12 months. The company's been paying your lease payment all year long. So you have that. The fuel costs, insurance of the vehicle, repairs, oil changes, all those different things. And if you bought the car, you're going to be able to take that depreciation, which is awesome, but including registration fees, dealer prep fee, and all that other good stuff that's happening. Like I said, telephone, another one. What about internet? Do you use your internet for your business? So you can deduct it, right? Absolutely. Bank service charges, office supplies, website expenses, travel. People miss travel all the time. You know, people are traveling by car rental, train, bus, airfare, lodging. All this adds up. Let's be honest, if I told you I had a deal in Alabama, and it's a home run deal, you're going to make $100,000 without just looking at it, wouldn't you fly there? Of course. That's an expense. You can write that off. Okay, professional fees, corporate renewal fees. What about meals? Oh, meals. Now they did change it in 2018, where they changed you cannot deduct entertainment anymore. All right, but you can still deduct your meals. So when you go out to eat, all right, these are different things. Some of the questions I get are these, and I put the section code up there for you and all that stuff, so if you guys are taking pictures and you want to look it up, you can look it up there. That's actually the law. That's what the law states and how it states. But a lot of times, you don't understand what Section 274 is or Section 162, Paragraph J says. That's my job to basically interpret what that is for you. Okay? So, can a corporation deduct meals if I'm having a meeting with my business? Yes. Can the corporation deduct meals for me and my spouse? Yeah, if she's an officer of the corporation, why not? Of course she can. All right? Can the corporation meals be purchased from the grocery store? This is very great, okay? Because I have clients that go ahead and have real estate firms that go out to Publix and will purchase $110 worth of stuff to come in and have a party for their staff, or whatever it is. They can deduct that, but proving it is a whole different thing. Documentation, you gotta have that all the time. Can the corporation pay for my meal at the ballpark with my business contacts or prospective contacts? Yes. It just cannot deduct the tickets to the game. Anybody deducting meals? Couple people? A lot of people missing a lot of deductions here. While you're paying taxes. All right, let's stop doing that. That's gonna do. Let's get back. So here's what I did. I did an average cost of some of the things that I do, and having well over 1,000 clients, I averaged out probably about 200 of them, and these are the averages I got. So I didn't use crazy outlandish expenses. They're all very normal. So auto lease, gas repairs, about $9,000 a year. Telephone, internet, $2,784. Professional fees, website, travel, all this stuff here, just these items, and there's many more, is gonna be $35,000 for the year. Do you think $35,000 is fair throughout a whole 12-month period of being able to write this stuff off? Or is that way too high? Not fair? Some of you more. I see people going out to dinner for $1,400. Well, why didn't they invite me? What's going on? But this is fair. So here we go. Corporation B, back to it, has $100,000 for the year. Direct expenses of $50,000. Indirect expenses of $35,000. So Corporation B has a net profit of $15,000. Anybody here take the QBI deduction in 2018? Qualified business income. Talk to your accountant. You might have missed that. It's an additional 20% that you get for real estate investors as well. So make sure you take that. Okay, let's basically go ahead and do the tax return here. And we did it. So here's a person, single individual, has that $15,000 profit. Section 199A, the 20% is $3,000. Their taxable income is $12,000. And what's the standard deduction last year? $12,000. What do they pay in taxes? $0. Wow. I got to write off all my meals, telephone, my car, lease payments, insurance. Unbelievable. You've got to take advantage of this stuff. Your accountant does know of these things. You've got to empower yourself to question what's going on. Always, folks, this is your money. Okay, you work hard for that money. You're out finding the deals. You're out there going ahead and telling people, you know, you're the one that's making, what, 4 or 5 hours on the phone? Don't go ahead and just waste your money. Make sure that you go ahead and ask all the questions. I implore you to ask questions. All the time, I tell all my clients, if you don't know, ask. We have to ask. Money's too tight and too hard to make not to ask. Okay, I'm going to go ahead and give you my information up here. Also, my wife's in the back in the corner. She's going to be going ahead and handing out cards. She's in the black. Say hi. There you go. All right, that right there. There you go. I'll be around for a little bit, and then I got to go pick up my parents from the airport. Thank you very much, and have a great day today.